Vibha Padalkar joins us. She's Managing Director and CEO with HDFC Life. Vibha, good morning and thank you for joining us. Now, FY19 has been a tough environment for the insurance industry, but things are looking up for HDFC Life. What led to the improved NBAP margins and overall performance?
Yes, we had a very satisfying Q4 and we had an all-round growth in our key metrics. Starting off with our top line, we grew by 17%. We had a very robust renewal premium. We had a product mix which showed an increasing share of both protection as well as longevity protection in the form of annuities. We also had a very good growth in our new business margin. So standalone Q4 new business margins were 25.6%. On a full year basis, it was 24.6%. We also ended the year with an embedded value operating profit of 20.1% on an embedded value of 18,300 crores. Our assets under management were 1,25,000 crores, slightly above that, with a growth of 18%. Along with that, what is noteworthy and very satisfying for us is our persistency metrics. So especially in the context of our standalone Q4 persistency metrics, so our 13th month persistency went up from 82% to 84%, and our 61st month persistency went up from 47% to about 53%, and thereby also taking up the persistency for the full year, especially for the 61st month persistency. So we are very pleased with the way Q4 has panned out, and we look forward to repeating this performance in the year ahead.
Right. Your NBAP margin drivers in FY19, Vibha, and what really do you feel is the outlook going forward?
If I were to single out one key margin driver, it would be product mix and our continued focus on offering products in the space of protection, which includes mortality, morbidity, as well as longevity. As far as the first two are concerned, our share went up quite substantially to about 27%, up about a percentage. If we were to look at our annuity business, the share went up from 2% of our EPI to about 5%. So that too more than doubled. So all of this put together was the key driver as far as our margins are concerned. Also, like I mentioned, persistency was in check, thereby helping margins, and our otherwise balanced distribution also helped in terms of what is the cost of acquisition that we have.
So can you tell us what the reason is for the lower solvency in FY19 versus FY18?
The solvency ratio dropped from 191% to 188%. The 400 basis points drop was because of our investment in our subsidiary. This happened in Q3 and we had mentioned this to you. This solvency drop is really only because it is not allowed to be counted as solvency, but the money, which is 166 crores, is still in our bank account earning interest, but just technically we are not allowed to count it as towards solvency because it was towards investment in our subsidiary. But if I were to leave that out, then our solvency is very much in line with the 191% that I talked about as an opening solvency.
Right. Vibha, bank assurance, and it's a crucial part of your insurance sector as well. Can you talk about the tie-ups and how is it that you see your distribution mix developing over the next 2 years?
Yes, so the bank assurance overall will continue to be de-risked by our own proprietary channels also. While bank assurance is important, currently we ended the year at about 64%, but you will find that our proprietary channels like our agency channel have started inching upwards. So our agency channel went up from about 11% to 13%. You'll find that our direct channel has grown to 10%. Our online channel has grown to 9%. So direct and online together has now grown to close to 20%. And you'll find that those segments growing. So excluding bank assurance, these proprietary channels have grown close to 30%. So that kind of a balanced product mix, which is in line with our stated risk management objectives, are beginning to pan out slowly but surely.
Now, you have been interested in inorganic growth plans. Have you finalized anything on this front? Is Max Life still on the cards? And can you just, walk us through the broad growth strategy over the next 1 to 2 years?
So we have, as you know, looked at several deals in the past 4 or 5 years, but unfortunately nothing has really fructified for various reasons. We continue to remain enthused, looking for the right from a target company, but things like their back book needs to be good. They need to have credible distribution, and the DNA of the company needs to closely match HDFC Life's DNA. If all of these things are in place and there is a meeting of minds between the buyer and seller, there can be a deal. But as of now, it does look like it is quite a difficult proposition for a deal to actually go through. You'll agree with me that there has not been a single complete M&A deal that has fructified in the life insurance space. And while we would love to be the first ones, I do think that the path is not very easy.
Let you go on that note. Thanks so much for joining in and giving us a flavor of how things are shaping up at HDFC Life.